Hello, I'm Michael Reinking, Senior Market Strategist at the New York Stock Exchange, and this is Market Storylines. Every week we're here to keep you up to date on the key trends and events driving global markets. Now, hopefully everyone enjoyed Memorial Day weekend and some time with friends and family. And we are recording on Thursday afternoon in what has been an eventful holiday-shortened week. So let's dive into this week's Market Storylines. Now, last week, markets had pulled back modestly in what seemed like a normal retracement following the very strong rally off the April lows. The primary driver of the weakness for most of the week was a move higher in long-duration sovereign yields after a couple of weak 20-year auctions in Japan and the US. However, on Friday, just ahead of the open, President Trump threatened 50% tariffs on the EU as he was disappointed with the state of negotiations. The S&P 500 opened down around 1%, testing its 200-day moving average, but ended off session lows, closing the week down 2.6%. Now, coming out of the long weekend, there were positive developments on both of last week's pain points and a jump in consumer confidence from the depths of the tariff turmoil, which helped major U.S. indices rally over 2%, recouping most of last week's losses. Now, in the most recent twist in the long and winding road of tariffs and trade negotiations, over the weekend, President Trump walked back that threat, postponing the increase until July to allow more time for negotiations after a productive call with EC President von der Leyen. Now, I'll come back to trade in a moment. Now, the other development helping to push equities higher on Tuesday was a rally in sovereign bonds. Now, in Japan, the Ministry of Finance reportedly sent a questionnaire to primary brokers ahead of a June 20th meeting, asking for their views on issuance, which raised speculation that it would scale back supply of long-duration paper. Now, this sent local yields in the 20 to 40-year duration down 15 to 25 basis points, reversing all of last week's move higher, which ultimately bled into Treasury markets. Now, last week we downplayed the importance of the U.S. 20-year auction, and before moving on, wanted to highlight that the 2, 5, and 7-year auctions this week have been very strong, with indirect bids coming in ahead of recent auctions, suggesting there is strong foreign participation, quieting some of the recent concern about overseas demand. Now, Wednesday was a pretty quiet session, with major U.S. indices pulling back ahead of a big evening of tech earnings. Now, shortly after the close, Nvidia put up very solid results as production of the Blackwell chip ramped up, despite the China headwinds, which the company said impacted revenues by $8 billion in the quarter. The CEO Jensen Huang sounded as bullish as ever about the evolving AI landscape and demand for the company's products. Now, the stock traded higher overnight, helping to push futures with it. Now, this would have been the story of the day had it not been for a court ruling from the New York-based Court of International Trade, which ruled that the tariffs instituted under the International Emergency Economic Powers Act, or IEPA, were illegal as the president overstepped his authority. Now, this includes the 10% baseline tariff, the reciprocal tariffs announced in the Rose Garden, and the fentanyl-related tariffs put on China, Mexico, and Canada. Now, however, the sectoral tariffs on auto, steel, and aluminum, which fall under Section 232, will remain in place. Now, the headlines were initially viewed positively, sending S&P futures up over 1.5% and helping Asian markets rally overnight. However, those gains began to fade this morning as investors started to handicap what this ultimately meant for the White House's trade agenda. Now, there was a second court case in D.C. this afternoon filed by toy companies that also ruled against the administration's tariff policy. Now, these court cases were a known risk for the administration, though at least from my seat, there were no indications that rulings were imminent. Now, as trade negotiations seemed to be progressing, investors had gotten comfortable with the direction policy was taking, which increasingly seemed transactional in nature. Now, for the administration, this is at least a bump in that long and winding road, but probably doesn't completely upend the agenda, though they will now have to pivot. The administration quickly filed an appeal and has asked the Supreme Court to issue an emergency stay while the appeals process plays out. Now, from here, they could also turn to other trade law to carry out their agenda. However, those tend to be more restrictive, can require an act of Congress, or require a formal investigation, which will take time. For the moment, this does defang the tariff threats a bit, but may not completely derail trade negotiations which the administration says are still moving forward. Now, today has been a pretty choppy session, and after major indices opened modestly higher, they have been waffling between gains and losses, but still remain higher for the week. Now, for the week, Treasury yields are down 5 to 10 basis points across the curve, with most of that happening today after an uptick in claims and a negative revision to consumer spending in Q1 GDP. Now, tomorrow is the final trading day of the month, and as things stand, the S&P 500 is currently up around 6%. Breaking a 3-month streak of losses. Now, it is the MSCI quarterly rebalance, so expect volumes to be elevated, and traders are also watching for signs of pension fund rebalancing given the big moves during the month of May. Now, ahead of the open, personal income and spending and PCE, the Fed's preferred gauge of inflation, will be released. Now, looking ahead to next week, clearly the legal proceedings and direction of trade will continue to be in focus. Earnings season is now pretty much behind us, with a couple of tech and retail stragglers left. The big focus next week will be economic data and the global central bank rate decisions, including Canada, the ECB, and India, which are all expected to cut. Now, in the U.S., the key economic data includes the ISM surveys and the labor market data. Now, that's going to do it for this week. If you like today's episode, please tell a friend, tell a colleague, or leave a comment wherever you listen to your podcasts. I'm Michael Reinking. Thank you for joining me. I'll talk to you again next week.